Morning, market chameleons. Happy Tuesday on the East Coast. We're about to get a big storm. D, how are you doing?
Pretty good. How are you, Will?
You ready for this snow?
Yeah, I'm getting ready, but I'm at home all the time now anyway, so I don't think anything's
They're
interesting.
saying 2 feet. Could be interesting. I don't know when the last time we had that much snow on the East Coast is, but it's or where we live by Philadelphia. But all right, how about starting with the disclaimer? What do you think?
Yep. Good morning, everyone. Thanks for joining us. Before we get started, keep in mind, Will and I, Market Chameleon, we're not registered investment advisors. We're not broker dealers. We're not telling you what to do. We're just sharing ideas. If you need professional help, contact your broker. That's what they're there for, to provide you with guidance, answer your questions. There's the disclaimer, everyone.
Excellent. What are you seeing this morning, buddy?
So let's take a look real quick. I'm going to bring up my screen here. So I think we'll take a look at what's going on in pre-market report. Maybe I'll show a different way of looking up open interest. I'm going to try to show a couple different reports every day that we usually don't cover. And I don't think there's much coming up on the earnings front. We'll take a peek at that and then maybe look at some bullish, bearish ideas. And if you have questions along the way, well, let me know. I'm going to try to get to those questions first.
Great.
So this is the pre-market report. We're looking at stocks that are trading prior to the market open. We have the most active stocks, biggest percentage gainers, biggest percentage decliners. First, let's just see what's going on in the higher market cap stocks. I'm going to use this filter over here and look for stocks that have a market cap of 20 billion market cap or higher. So you see 45 of them made our percentage gainers list, 5 on the percentage decliners list. So at least from that perspective, it looks like a much more favorable to the bullish side than the bearish side. Couple of them that are up top, MT up 5.1%. That's 45,000 shares trading in the pre-market hours. BIDU up 4.3%, trading 108,000 shares in the pre-market hours. Looks like these little ends are saying that there's some top line headline news on these, so you could just hover over, take a look at that. NIO, that's up 3.6% in pre-market hours. Nothing jumps out at me that much. These aren't 45,000, 108,000 shares. It's not a ton of shares considering like these are higher market cap stocks with bigger floats. I'm going to go to the unfiltered report really quickly. See what jumps up top. So we got PRVL, that's up 85% in pre-market hours, 824,000 shares, and I think I was reading that's on the takeover from Eli Lilly. OCX up 76%. That's a lower market cap stocks. That looks like that's also biotech. So I think what we'll do is maybe look at some insights of what some of these pre-market movers have done in the last 2 weeks. So let's take a look at that for now. And I'm coming down to this report here. On this report, we're capturing market gappers in the last 2 weeks. So stocks that either gapped up in the morning. So this is the gap up tab, or gap down in the morning. So let's stay on the gap up for now. And we see that down here below, this is the data table. And we have 3,304 stocks that gapped up in the morning, made our gap up list. And we are capturing the date, the symbol. This is the name of the stock, the industry it's in, its market cap. This is the volume in the pre-market hours. So here we see this stock, COTY, opened up $7.27. That was up 5% from previous day's close. Then we look at what happened to the stock after the open. So we see at 10 a.m., which from 9:30 to 10 a.m., you get, a lot of volume, usually the first half hour and the last half hour of trading are the busiest. So we see here by 10 a.m., this stock was down 4.3% from the opening price. And by the end of the day, this stock closed at $6.66, down 8.4% from the opening price. So what we see here is, yes, it was up 5% in the morning. It didn't hang on to those gains. It didn't gain more. it actually started drifting lower from that price. So that's the insight on that gap. So let's take a look as a whole, what happened to all the stocks on this list. And from all the gappers by 10 a.m., the stocks that gapped up in the morning, 47 of them by 10 a.m. were higher from the opening price, 52% were lower. By the end of the day, only 46% of them were higher, 54% of them were lower, and as a group, on average, they lost 0.2%. So let's compare that. What about the stocks that gapped down, right? So here, as you could see, the majority of them, more than 50%, were lower after the opening. The ones that gapped down, that looks like that reverse. So 52% of those that gapped lower were higher by 10 a.m. from the opening price, 47% lower. By the end of the day, 57% of them were higher from the opening price, 42% were lower for an average gain of 0.7. So what this is basically saying is, if you're just 50-50 shooting a dart and just saying, not knowing anything about the stock, your odds of success were better on the gap down than the gap up if you're just buying, holding it to the end of the day. So that's the general insight. Let's go back to the gap up and see if we could improve these numbers. So let's say we filtered out from this group, just as a comparison, what about stocks that gapped less than, so what about the biggest gappers, more than 20%? So we could see the ones that gapped up more than 20% actually fared worse. So only 41% of those were up by 10 a.m. compared to 47% to the entire group. And by the end of the day, only 34% of them went higher, 66% were lower compared to the entire group of 46% and 54%. You could see on average, your losses were down 2.5% if you went long those gappers more than 20% to the upside versus just all of them. So let's see if we could go the other way and say, what if the gaps were smaller, like less than 0.5%? So those that gapped up in the morning, but less than 0.5%, 49% of them were higher by 10 a.m., so slightly better than the entire group. And by the end of the day, 46% were higher, 53% were lower. So similar to this, but the average loss was less. So what this is saying is the lower the gap, they did better, but you're still, look at your chances, those odds are still less than 50-50. Let's take a look at what about stocks that were in the S&P 500. So here I'm going to just look at S&P 500 stocks. So the S&P 500 stocks fared better than the rest of the group. We see here if the stocks that gapped less than 5% and they were in S&P 500, 54% of them were higher by 10 a.m. versus 47% for the entire group. And half of them were higher by the end of the day, half of them were lower, which is, it's still 50-50, but better than the entire group, 46% versus 54%. Let me add market cap to it. Let's just see. What if we went really high in the market cap, 50 billion? So the 50 billion didn't really improve by 10 a.m. They were higher, but not really, slightly better to the close. Let me just play around with this market cap. What about 1 billion to 10 billion? So they're slightly better, an average gain, but still pretty close to the entire group. Let's do the gap down. So in the gap down here, we see in S&P 500, I still have these set up here, these filters. So we see here, stocks that were in S&P 500 and gapped lower. Let me remove the market cap here. So stocks that were in the S&P 500 gapped lower, 63% of them were higher by the end of the day, 37% were lower from the opening price for an average gain of 0.8%. So what this is saying is that S&P 500 stocks gapped down. In the morning, investors tended to scoop them up by the end of the day, they were higher more often than lower, and those were actually a better deal than the ones that gapped up. That's all right. So really quickly, just showing you how to use some of it to gain some insights, right? So if you're throwing darts, not knowing what to do, this group here fared much better than the other group. Any questions on that, Will? If not, I'm gonna keep going.
Yeah, you can move on. That was great.
Okay. Let's take a look at unusual option volume really quickly, and I'll show you another way to kind of take a look at the because I get questions about open interest and volume. So this is a different way maybe to go and really quickly visually see where the volume was in the open interest. So this is the unusual option volume report from yesterday. Let's look at ones with high call volume. So let me use this filter. Here's like something with high call volume. And let's say we wanted to see a breakdown. Well, we know this traded a lot of volume yesterday, 48,662. That's 52 times its average daily volume on a ratio basis. So if we compare yesterday's volume to average daily volume last 90 days, that's 52 times its average daily volume, $8 million worth of calls traded versus $743,000 worth of puts. And we see that this stock was up 52% yesterday.
Actually, we had a new chameleon mention that stock early this morning, that he's been looking at it for a couple days.
VERU?
Ryan, yeah, VERU. That's interesting. Cool.
Yeah, so let's see if we could get some like visual insights into how where the calls were trading, where the puts were trading. So I'm going to hit on this VERU. Actually, this link will take me to the options chain, which is another way you could kind of see, like, in the options chain, we see December 18th, 35,000 of the options traded yesterday. On this expiration, 8,000 on January 15th expiration, and a couple out in the longer dated options, 1,900, 1,800. You can just kind of view from here. These are the volumes. Here are the calls. You could see 8,000 traded on 10 strike on the call side, and you have the volumes next to each option. But what I was going to show you is I'm going to come here to the activity. And on the activity, it's like a summary of what happened. So here's each of these expirations, December 18th. This is the implied volatility. It was up yesterday. This is telling you how the options are skewed. So we could see that the upside call is skewed 20% higher than the at the money's downside put. So the skews to the upside based on these numbers over here, 0 and 0, meaning that there's no skew. The out of the money put and out of the money call are same implied volatility as at the money. Here is the volume, 35,000 traded in December 18th. So if we just click on it really quickly, it'll show us a visual where the volume was. So we see here a lot of calls traded on the 15 line, 12.5 line, 10 line. So if you hover over it, it tells you how many. So you could see 5,857 calls traded on that line versus 39 puts. And it's a really quick visual of where the options are trading. This is how the options traded throughout the day. So most of it you see in the early morning. This is where the big spike in volume was. Here's another one here by, this is between 10:05, 10:10, and then it kind of died down. This is
AD. We got a quick question from Femi. She just wants to know the difference. She's a new chameleon on the chat. The difference between open interest and volume.
Yeah, so that's a good question. That's what I was getting into. So the volume throughout the day is just how many contracts are being traded. The open interest is based on settled trades at the end of the day that are not yet closed. So they were open and not closed. So you could actually have a lot more volume than open interest. And, so for example, if Will and I trade 1,000 contracts through the day, and then we trade out of that 1,000 contracts. So he's, I buy 1,000 contracts from him. Then later on the day, I sell him back 1,000 contracts. Well, the volume was 2,000, but the open interest would be 0 because we completely closed out of it, right? Or if Will sold me 1,000 contracts, they're deep in the money, there's 1,000 volume, but I exercised them. So at the end of the day, there's no open interest because I converted those options to stock. There's no more options left over. So there will be 1,000 volume, 0 open interest. Or let's say Will sold me 1,000 contracts. So the open interest is 1,000, there's 0 open interest. We created a new contract. Will sold me 1,000 contracts. Open interest is 1,000. Let's say I took my 1,000 contracts and sold it to, Joe Smith, right? So I took my 1,000, sold it to Joe Smith. So even though the volume would be 2,000, right? The transaction between me and Will, then the transaction between me and Joe. So that's the volume is 2,000, but the open interest would only be 1,000, right? Because I'm completely removed from it and the open interest is between Will and Joe. So does that make sense why volume and open interest can be very different? Because a lot of people, they see, oh, if there's 35,000 volume, why is the open interest 19,000? Does that make sense to people?
Yep, very much. They're very thankful.
Okay, so now looking at that, we could just see here, this is what transpired yesterday. So these two graphs are just saying how was the volume in the calls and puts distributed on the strikes. So you could see here, 7 strike, 10 strike, mostly calls. These blues are the biggest. Puts were on that 7.5 line, were 4,102. And this is just looking at December 18th expiration. This tells us what time of day those transactions occurred. So here it's in the very beginning, and then it kind of slowed down. And this tells us how historically on this expiration, how the volume looks. So we see that, the volume kind of spiked in December 10th, slowed down a little bit December 11th, and then spiked back up December 14th, right? So this is volume by day. And mostly we see December 9th, December 10th, December 11th, December 14th. The majority of that volume was in the calls. That's what this yellow bar is. The blue bar on top of that, that's the puts. So when you stack it, that's the total volume for the day, okay? If that makes sense to everybody, now let's look at the open interest.
We got a couple questions. Can I hit you one at a time?
Yeah.
First, Lev is asking, does higher call volume always tell you, and I don't think anything can be classified as always, does higher call volume tell you that people are getting more bullish?
Well, it's not necessarily, you'd have to kind of go take a look at it. If people are selling, people trade options could be for different reasons. Sometimes it's volatility. Sometimes it could be that they're buy writing and they have positions and they want to sell calls to the market makers to make yield. Sometimes it's part of a spread. They could be, buying a call, selling something else against it. So you'd have to kind of go and try to, you're making interpretations based on other information around, the options chain around what the implied vols are doing, so you still have to make an interpretation. So no, it doesn't necessarily mean that they're bullish, but if you kind of just take a look at how the calls are, how those trades are coming in, how it's flowing, what other trades are occurring around there, you'd have to make that interpretation. And I think one of the ways we did that order sentiment yesterday is we try to break down the trades. Let me just go to the order sentiment really quickly.
Yeah, I'm going to put a link to last night's great webinar that Dmitry did on order flow sentiment, and there were a lot of interesting comments in there, and you gave a great representation of what to look for. So the link's there to the YouTube channel.
Right. We were talking about it yesterday. So what we do is take out, like we were talking about the noisier trades, like the spreads, contingent trades, with stock and stuff, and just look at call buying versus put buying. So here, according to our order sentiment, it looks like the way that the order flow is flowing is signaling people's bullishness. In other words, in last 30 days on average, there's 194,000 bullish call buying versus 36,000 bearish put buying. That compares to last 5 days. You can see that started to increase, $836,000 worth of bullish call buying versus 98,000 bearish put buying. And then yesterday was like really, way above the 5-day average or 30-day average, $2.5 million worth of bullish call buying versus 182,000 bearish put buying. So that's why we're getting the signal and strength of there's an increase in bullish. And this is looking at for particular types of trades, not every options trade, but trades that look like they're single-legged trades buying calls on the offer. Does that help?
Yeah.
So let's take a look. Also, I'm going to come back to that activity. And let's take a look. So here, and we have here open interest. So if you click on that, this kind of tells you where the open interest is concentrated. So we see on the 7.5 line right now, that's the majority on this expiration, December 18th. This is the open interest. We see it's climbing, right? From day to day, it looks like yesterday climbed the most. So that's how you're looking at the concentration by strike, and then you get how it progressed through history. So we see that it's going up, right? Since December 9th, it's going up on this December 18th. And we could see here, that December 18th has the most open interest. The next one, January 15th, 9,000 contracts. So here we see open interest, biggest concentration right now is in the 7.5 call. I think we blew right through that already yesterday. And we see it's been climbing, it's been kind of steady. In the last 3 days, it's been climbing. If we want to get a perspective on a relative basis, I'm going to go here to this open interest tab, and let's look at this December 18th. So I'm going to click on there. So this is showing us open interest relative to the average daily stock volume. And again, here's the 7.5 call. And what this is saying is if all these contracts get converted to stock, right, at expiration, if they get all converted to stock because they're in the money, that represents 12.8% of the average daily stock volume. Okay, so this is looking, actually comparing it to the stock volume, not just the option volume. So imagine if on average, if this traded 1 million shares of stock per day, and if this converted to 1 million, that would be equivalent to a whole days of stock volume trade. But this is 12.8%. So you could see here the next, we got the stocks right now, 1095. So around here, so that's if everything got converted to stock today, that would represent 10.2% of the average daily stock volume on this strike. All right, so that's what this is saying. Let's take a look at January. This is January 15th expiration. Okay, so here again, so far, the biggest concentrations in that 7.5 strike, and that was probably created prior to yesterday's move. We broke right through it. So you could see so far, not a whole lot of open interest on these upper strikes, but that could change, as we go forward. And these are in the puts. So the top ones are the calls, the bottom ones are the puts. Is that any questions on that open interest?
Nope.
Here's how it progressed in the last 5 days. So we see here in December 18th, you just get a quick overview. 69.5% of the open interest is in the calls, 30% are in the puts on December 18th. In the last 5 days, open interest increased by 19,000. So most of this open interest was created in the last 5 days. Right now, 19,281 open interest. In the last 5 days, most of it wasn't created. In the last 4 days, 18,000 of it, 3 day, 2 day, and then 1 day. Yesterday, about half of it. Okay, So that's how, really quickly looking at the open interest. Do you guys, let's take a look at, I'm going to stay on this for a little bit. Let's take a look at SPY on activity. So what this is saying in SPY, let's look at the volatility skew here. We did the volume, we did the open interest. Let's look at the skew. So the skew here, what this is doing is saying, well, if we took the at the money implied volatility in SPY, right? So we look at SPY and we looked at the at the money volatility in each expiration, right? So December 16th at the money volatility is 18. Yesterday was up 5.6. And how does the at the money compare to an out of the money put or an out of the money call, right? Are they the same volatility, or if people buy on a relative basis, are people paying more for the put than the at the monies or less? And what are they doing with the calls? In SPY, you usually see that the downside puts, right? People buy protection. So those on a relative basis will be higher than the at the money. And the calls, usually people buy right. So you'll see on a relative basis, the out of the money calls will be a little bit cheaper relative to the at the money. Let me show you actually how this would look. Let me know if you have questions. Well, this is like turning into almost a webinar, but
We did have a question in Expedia.
okay.
And then another for the, I mean, these are heavy chameleons who are on all the time. So Gene was asking about Expedia, if there's anything maybe showing up of interest in Expedia, EXPE.
Okay. So let me try to get to that. So over here right now, SPY is around 365, which where it closed. This is the strike. So you could see that the implied volatility is around 18, right, for the call and the put. But if we go down in the puts, we see the implied volatility climbs. It's higher, all right, 26. If we go down 2.7%, the implied volatility in those puts is 26. So relative to the at the monies, we see that implied volatility is higher. As you go up, you could see from 18, go up 2.5%. It's the implied volatility in the call is lower because people tend to buy right, to sell calls against positions, and they protect their positions by buying puts. So you'll see this skew. And this here, the volatility skew is telling you on a relative basis that if we look at a 25 delta put, it's 19 or almost 20% higher than that the money. So that the money is 17. So the 25 delta put is almost 20% higher on a relative basis. And the 25 delta call is almost 10% lower on a relative basis to that the money. So that's what this skew here is letting you know. And you could see that for each expiration. Okay.
Excellent.
So last thing here, if you wanted to convert, well, what is the at the money straddle implying? So if you bought the call and bought the put at the money, right? So you're looking at the movement, on a percentage basis here, December 18th, what it's saying is that the stock is expected to move 1.9% in either direction, or $6.83. Okay. So if you buy the straddle moves more than 1.9%, it would be profitable. If you sell the straddle moves more than 1.9%, you'd have to buy it high, buy back more. So it would be unprofitable. And then that, if you sell it, it's in reverse. It would have to move less than that. Okay. So it's 929, Will. Let me see if I could, what was the
EXPE? Maybe just go to the summary page, see if there's anything showing up.
So yeah, let me just go to summary page. Let's just see what's going on in EXPE. I'll just tab through sentiment. There's no like bullish bearish indicators. Let's look at the trade ideas. So here are the top 3 trade ideas by theoretical edge. You can drop this down, look at other ones, but let's just get to the simpler ones. Bull put spread. It's saying selling the 122 put in December 24th expiration, buying the 117 put December 24th expiration for a credit of $1.57. That's where the market is. We think it's worth 97 cents. That's a 17.5% theoretical edge with a historical probability of success 76%.
Awesome job, Dima. That is the bell.
All
Great
right.
job today, buddy. Listen, everybody, thanks for joining us. Nag S had a question about a iron condor he has on. Maybe we can get to that tomorrow or put it in the forum.
Okay.
Great question. Dima,
Yep.
great job, buddy.
All right. Thanks, everyone. Hope to see you guys tomorrow. Have a great trading day. Stay safe.
Have a safe trading day, everyone. Peace.